Well, I think it's time that I up my warning on the financial markets that I issued, what was it, 2 days ago, after Jay Powell came out and gave the Fed's update on their policy and essentially, charted the course for the next 4 years of Fed policy, saying that they were not going to be raising rates at least for another 4 years. But the caveat to that is that Powell essentially said, this is it. You're not getting anything else out of the Fed for now. There's nothing else the Fed can do. The Fed is essentially doing as much easing as we plan on doing, and the rest is up to Congress. Essentially, the Fed has told Congress, hey, whatever debt you issue, we're going to monetize it, so you can spend as much money as you want. But the Fed apparently is, they're out of ammo. They're spent when it comes to propping up the stock market. And, while they're saying that publicly, they still do have the one last option of actually just going out and buying stocks, which would be, the most overtly corrupt, Wall Street insider kind of game that the Fed could play. But, the Fed gets away with so much as it is. Maybe it's not such a stretch for them to go out and buy stocks. But as of now, Jay Powell is saying that's not going to happen. Jay is saying this is it. The Fed is all in at this point, and you're not getting anything else out of us. And that, to me, if I had anything in the stock market, I would have pulled everything out on Wednesday. Or Powell might have actually spoken on Tuesday. I can't remember which. But the market really hasn't sold off. I mean, I think we're technically red for the week as of today, but we weren't, we were still green for the week after Powell gave his comments, though it was disappointing. The market was hoping that Powell would have something new to sweeten the pot. But we didn't see a major sell-off after Powell's statement. So, we had to, this market, since really Trump has been elected, has been built on optimism. First, it was tax cut optimism, and we got a big rally off of the tax cuts, the, corporate tax cuts, which, I won't get into the details of that, but basically, I guess I will. When you cut corporate taxes, you increase a corporation's after-tax earnings, and so when a corporation's earnings go up, their book value will go up. If you're using the same multiple, the company is now worth more money. And so because of that, the value of every publicly traded company, and every other company for that matter, went up as a result of the tax cuts. And so that produced a big rally in stocks for the time being. And then, there were trade wars and things. And so, and Trump was negotiating with China. And then we had trade talk optimism. That's what, the next rally was built off of. And for a long time, we had people being optimistic about the trade talks. And then, what was it? December 2018, the Fed had been raising rates for a little bit. They got up to 2.25%. They said the balance sheet runoff was on autopilot, essentially saying the Fed is pulling liquidity out of the market. We have this big crash, 20%, like 18%, I think, on the S&P. And the Fed flip-flops, they change course. And then ever since then, every rally has been built on Fed optimism. The market has been optimistic that the Fed will continue to ease and keep easing and bumping more liquidity at ever increasing rates into the market. And that ended this week when Powell announced that pretty much this is it. So that is the significance of Tuesday. It essentially was it marked the end of an era that lasted, well over a year, almost 2 years of, the market rallying on Fed optimism. So they had to find something new to be optimistic about in order to continue going up. And that was, stimulus deal optimism. Something which I warned was not too likely. There's a lot going against, another stimulus package. And the idea behind a stimulus package is not that it actually helps the economy, because it doesn't. What a stimulus package does is gets people to spend money. It increases consumer confidence. It makes people feel like the economy's doing better, and so then they're going to feel more comfortable buying stocks. And so it's another form of optimism. If there's a stimulus package, it will increase optimism, get people to spend more money, and stocks will benefit from that. That was the logic behind stimulus, deal optimism. But Nancy Pelosi came and pricked that big optimistic bubble today with a statement, a very simple statement, essentially saying that sometimes something is not better than nothing. And what she meant by that is that, in the last few weeks, the Democrats and Republicans in Washington have been fighting over what their next round of free money handouts are how big the bill's going to be. The Democrats want to spend $2.2 trillion on this latest bill, and the Republicans want to spend $300 billion. It really doesn't matter which one gets picked, because the government this year has such a massive deficit. Both of them are going to have to issue. They're going to have to issue all of that in debt. That's all debt. They're borrowing all of it, and the Fed's just monetizing all of it. So it's just a question of how many zeros the guy at the Fed has to type out on his computer to add into the money supply and to buy up these treasuries. That's really all the Republicans and Democrats are fighting over. But and so somebody was interviewing, I believe on MSNBC, interviewing Pelosi, and they said to her, hey, we get that you want the $2.2 trillion, but if the Republicans are at least offering $300 billion, why not take that and then try and get the rest of your $2.2 trillion later? Why not just take what they're offering at this point? And she said, sometimes something or nothing. Something isn't always better than nothing. And so Pelosi, at this point, is, she's going all for nothing. All or nothing. That's how she feels about this whole situation. She'd rather hold out for the full amount that, that she wants and all the programs that she wants to fund. And so there's two possibilities of where we go from here. First of all, this is bad for stocks because it's by now it's in no way guaranteed that there actually is going to be any kind of deal, because Pelosi is standing her ground and is playing hardball to some extent, and there's a pretty short amount of time before the election, meaning that the odds that the two sides decide to sing Kumbaya and come together and mend this divide beforehand is pretty weak. Any deal is probably going to come after the election, maybe next year, and by then it will be too late. The markets constantly need new injections of liquidity in order to sustain this this horrible disfigured beast known as the U.S. equity markets. And diving more into the politics of this whole situation, I think that it really is a win-win for Democrats at this point, because what Pelosi's doing is she's got two options here. One is that the Republicans say, "Oh shucks, we give in," and they give her whatever she wants. And if the Republicans are willing to do that, that means that the Republicans really, really want to get a deal done. And if they really, really want to get a deal done, then Pelosi can just throw in whatever she wants. She can throw in all sorts of pork and things and little provisions that people in the Democratic caucus from various districts want, and this can be a huge, huge win for her politically. Maybe even a bailout of New York City and some other financially troubled municipalities, and so she will be able to tout that as a big win, because she, in this case, will have gotten the Republicans to concede to her and come over to her side. It's not her agreeing, to some deal that, that the Republicans had a hand in creating. They essentially would be the ones signing on to her bill. And so that's the first possibility. Now, the other possibility is that Nancy Pelosi stands her ground and the Republicans stand theirs and nothing gets passed. In that case, if there is clearly partisan gridlock, then the markets are not going to be happy. And I don't think markets can make it to Election Day without some good news. They need some optimism to rally on, or else, we're just going to fall off a cliff. And if that happens, of course, it'll bode quite well for the Democrats, since they are trying to unseat a Republican incumbent in the presidential election. They can blame all this on Trump, say how Trump has failed us, he's destroyed the economy. Look, your 401k it's just in tatters, it's in ashes, whatever metaphor you want to use. And that potentially might be the most effective thing that Pelosi could do in this situation, is not really try that hard to get a deal done before the election. try and hold out until then and see just how much damage can be done to the stock market. And that could scare enough people into making sure that they go out and vote for Joe Biden, especially those middle-class white suburbanites that the Democrats have been courting so much. Those people, they care about the stock market a lot because they actually have money invested to retire. A lot of, your ordinary working class folks that historically Democrats have tried to appeal to, they don't really care about the stock market that much, or at least not directly. They might look at it as some kind of a barometer for how the economy's doing, but ordinary people can't afford to put any money in stocks. They live paycheck to paycheck. And so a major stock market crash would go a long way in securing the suburbs for Joe Biden and for the Democrats in general, because they could promise that, hey, we will rescue your 401ks with a big bailout after the election. Just vote out these nasty Republican obstructionists and we'll get it all done. If I were a Democratic strategist, this would be by far the most appealing strategy to take going into this election. And so therefore, if I were someone invested on Wall Street right now, I'd be very nervous in the short term, and I'd be even more nervous in the medium term because, of course, things are terrible in the markets anyway. We have had these fake markets for quite some time that are just completely bloated with debt and with fake money that's just been pumped in to try and inflate the price of assets. Now, all this is just one risk. The lack of a stimulus bill is one risk to the equity markets heading into the election. But the election itself, I think, is an even bigger risk because, as I've discussed in two previous videos, we're not going to know who's won on election day. And it's possible that even after the election and all the votes are counted, if it looks like Trump is actually going to win, there's going to be a lot of opposition to that, a lot of challenges in the court, and potentially people trying to get Trump and try to force Trump out because he's illegitimate. All this will create a lot of uncertainty, which markets hate uncertainty, which is going to lead to this. All of these factors are adding up to a big drop-off in prices because again we're at all-time highs. When you're at all-time highs, you've got a lot more room below you than you do above you. Stocks do not go up during a depression forever. They have to stop at some point and move to where the economy is. I mean, are we going to hit 200% market cap to GDP? And remember, stocks are just the first shoe to fall. All of this economic devastation has happened before the stock market has even crashed. Back last year, when I was talking about what the big depression that we were heading into was going to look like, I was talking about everything that happens after the stock market crashes. The stock market crash was step one in my scenario. But here we are already in a depression, and the stocks still have not gone down. And once they do, that's going to obliterate consumer confidence. It's going to the wealth effect is going to take all of that motivation to spend out of all these people who have a lot of money in the stock market and are feeling rich. The wealth effect is when the price of your assets go up, and so your net worth increases. You don't have any more cash in reality, but you feel richer, and so you feel more comfortable spending more of the cash that you do have. And this leads to greater consumption in a society. This was the cornerstone of the Fed's plan after 2008 to try and rebuild the American economy. It was to trick people into feeling rich so that they would spend all of their paycheck every week, which, in the long run is a terrible, terrible idea because you end up with a situation where people are living paycheck to paycheck and have no savings. Of course, they don't think they have no savings because they think they have all these assets, in the form of stocks and housing and bonds. But as soon as the air starts to come out and people see, what looks like troubled times ahead, what do they stop doing? They stop eating out so much. They stop buying so many cheap plastic toys at Walmart. They stop buying, brand new designer clothing. They stop investing more in their business because they just want to make sure that they preserve the capital they already have. They want to try and make sure that their balance sheet is bulletproof. And so then you finally end up with what this market has been desperately been in need of for years, and that is a true economic recession. The very deep depression that we've been in this year really was artificial because of the lockdowns. But we are not really, we still aren't in what a traditional cyclical recession would be. People have not stopped investing. Interest rates have not gone up or down at all. They've stayed exactly the same. Unemployment has not been allowed to fall nearly as much as it should because of the PPP loans and other bailout measures, essentially trying to kick the can down the road past the election. Mortgage forbearance and rent, I don't know if they call it forbearance when it comes to rent too, but basically anyone who is occupying a home or an apartment that has an FHA mortgage attached to it, or any, I think, government-backed mortgage, they don't have to pay their mortgage or their rent for the time being. And so there's a ton of people who would all else equal, be homeless right now, be getting booted out of their residences, which of course would send the price of rent and the prices of housing through the floor. It would drop like a stone if suddenly we had a mass eviction event or a mass foreclosure event. And that's exactly what it looks like we're up for next year after the election, because when all this forbearance expires, these people are supposed to pay all the payments that they haven't been making. Their payments have not been wiped out for these next few months. They're just getting delayed until the end of forbearance. And so when you've got all these people who haven't gotten their jobs back and haven't been able to earn all the money that they've, to cover all these costs, these are going to have real consequences at the end. So, with that said, I think I've said enough for today. If you gained anything of value out of this video, I'd appreciate you clicking that like button and sharing this video. And if you haven't already, please do subscribe, because I do upload every day, and I'd hate to have you miss one. So, I'll see you folks back here tomorrow.